Boy, this is just about the latest I've ever started recording for the day, but I'm not going to miss today, even though I had a very long day and I was not able to get a video out as early as I would have liked. And that's because I saw something very thought-provoking today. I listened to an interesting video from George Gammon, who, if you guys don't subscribe to him, he's great on general financial stuff. Has a really good channel where he goes through some whiteboard videos. And I listened to him. He finally put out a video on an idea he's been developing with regards to the mortgage market. And it's an interesting point that I'd like to go over and, if I may, if not critique, question a little bit, because there's a couple points from his video there's a couple of holes that I would like to fill, or at least see him fill, because I don't know necessarily what the answer is. So I have questions. Basically, George correctly surmises that a big part of the bubble, our economic bubble, our so-called economic prosperity, is housing prices, and a strong housing market, a rising housing market. This housing market is a direct result of low interest rates. Over the last couple of months, we've been seeing yields in the bond market start to creep up. This is despite the Fed saying, which I've covered this myself about the bond market. The Fed is pretty much trying to be as bearish as possible on inflation. Or actually, you know what? I shouldn't put it that way. They're bullish on inflation. Is again, this is kind of a contradiction, so forgive me. They're bullish on inflation, but they're bearish on bond yields and on interest rates. The Fed has made it clear they want to keep interest rates as low as possible. Yet, despite that, the bond market is pushing interest rates higher, and this poses a direct threat to the housing market, because as the bond market, creeps higher and higher, and it's gone up a lot. Yields in the Treasury market, that is going to have a trickle-down effect on the rest of the economy, but namely housing. And as mortgage rates go up, there's going to be less demand for housing, because if your mortgage rate, if the interest rate on a mortgage that you're paying goes up, that increases your monthly payment, and so that means that won't be able to afford as expensive of a house in terms of the list price. In terms of how much you're financing, you won't be able to finance as much because you'll be paying more of your payment in interest. And so a direct result of rising interest rates, rising bond yields, is a decrease in housing prices, which could just break our entire system, because, as I've pointed out in the past, very fragile system we have here, all built on debt, and if things don't go absolutely perfectly, then you can just have one little monkey wrench that gets tossed into this big complicated machine, and it all shuts down. I won't get into that here, but if you want to scroll back through the past in the channel, or if you're familiar with what I'm talking about, you can, this is covered elsewhere. Bottom line is, the Fed cannot allow mortgage rates to rise and allow the housing market to start to unwind, to start to fall and ultimately collapse spectacularly. And so George asserts, I think correctly up to this point, that the Fed's move then will be to go into the bond market and start buying these longer-dated U.S. Treasuries, your 10 years, your 30 years, your 20 years. This is where we're seeing real big spikes in yield. I think recently, I didn't look today at what bonds are doing, but I mean, last I checked, the high for the week was like 1.61 for the 10-year. It was under 1% not too long ago. So, again, these are very big moves. So the Fed, if this continues, will be forced to come into the bond market and to buy up these bonds from financial institutions. And when they do that, when bonds are, just like with any asset, if there's more buyers than sellers, if there's people coming in who want to buy up these scarce resources, the price is going to go up. But when the price of a bond goes up, yields start to fall, and yields are the interest rate. And so by coming in and buying bonds, what the Fed is doing is suppressing interest rates. So does that make sense so far? Now, this is where George gets into the problem of the Fed doing this. Because normally when we talk about the Fed lowering interest rates, oh, okay, yeah, the Fed can just go out and buy bonds and make sure that the bond market is never allowed to falter and for yields to rise. All the Fed does is every time is make sure that they just buy enough bonds and that they keep high enough demand in the bond market to ensure that interest rates remain low. Well, they run up to a constraint where this is concerned, and that's because, and this is something where this is a field where I'm not as sure, but I'm going to take George's word for this, because again, I'm not a banking expert. But what he's saying is that the banks, because the Fed is going in and buying these bonds up not from ordinary Americans, but from big institutional players who hold billions and billions in U.S. Treasury debt. And the way that the Fed pays for them is by crediting these banks' accounts at the Federal Reserve, because all banks have, the Fed is the banker's bank, and so all these banks have accounts at the Fed, and the Fed just credits, dollars into their account. And what George says is that when these banks get these new reserves injected into their account, they don't want to just park it at the Fed. They would rather go buy something that is as safe as parking their money at the Fed, but gives them some yield. And so what that ends up being is U.S. Treasury bills, which are essentially like bonds, but they're dated less than a year. So when you're talking about, if you look at this in terms of the yield curve, the Fed in trying to in buying up long-dated bonds from these big institutions, what they're essentially doing is based on George's analysis, they're driving people from they're shifting these banks from holding bonds at the long end of the curve all the way at the short end. They're increasing demand for Treasury bills at the short end of the yield curve, and at that end, unlike the longer end where you have everything over 1%, you have the 30-year over 2%, you've got yields rising. You're going to see the Treasury bills are at near zero already, and with this increase in demand created by the Fed going in and buying all these long-dated bonds, driving the banks into the short-term paper, that could push yields negative. And this is something the Fed cannot allow either, at least according to George, and according to a lot of bankers too. A lot of the Wall Street folks think that the Fed is going to stand firm and not allow yields to go negative anywhere in the bond market when it comes to the Treasury. And so in order for the Fed to raise to keep interest rates above zero at the short end of the curve, what they would have to do is raise the Fed funds rate. They would have to try and push it to raise interest rates. That's the only thing they could do, because what the Fed controls is short-term interest rates directly through the Fed funds rate, almost directly, as direct as the Fed controls anything. Let's put it that way. But if the Fed raises the Fed funds rate above zero, or raises the Fed funds rate, period, to keep real rates, or I should say nominal rates, in the bond market above zero, this would have push upward pressure on mortgage rates. Because if the Fed raises the Fed funds rate, that is a signal to mortgage originators, hey, we need to start charging more in interest. Because again, the Fed funds rate is sort of the most basic interest rate. It is the benchmark interest rate, or well, maybe that's the wrong term, because sometimes people use the 10-year bond they refer to that as the benchmark interest rate. but basically, the Fed funds rate is the most basic thing. And so if the Fed funds rate is rising, then that signals to people all across the economy, to lenders, that, hey, rates are going up. We need to start charging more in interest. And if you do that, then again, you're going to have the same problem with the housing market that I outlined before, that the Fed was trying to avert by buying the long end of the curve. Are you confused yet? Maybe if my simplified explanation maybe cuts out too much detail, you can go watch George's video on it. I think it's very clear, but then again, this is the kind of stuff that I think about a lot. So, maybe not everybody will get it on the first try. But this is extremely important because it gets at a question that I've been wondering for a long time, and that is when. I know that the Fed can't keep this up forever, but when will they finally? Will their days be up? When will they not be able to keep a lid on this whole situation anymore? And so let's back up a little bit and go back to the point in which short-term, the Fed is trying to suppress and make sure that the long end of the curve is not rising, that you don't see the 10-year Treasury bond hitting 2% or 3% or 4%. They want to prevent that. They want to push rates down. So they're buying up bonds, long-dated bonds, and pushing financial institutions into the short end of the curve, thus driving short-term interest rates negative. Let's say the Fed does nothing. This is sort of the crux of George's argument, why he thinks they're backed into a corner. And this is where I start to question what George is saying. The Fed does nothing, allows interest rates to remain negative at the short end of the curve because they're more worried about just suppressing long-term rates. And so they continue with that. And, the 3-month, 3-month and the 6-month and whatever other, less than 1 year Treasury bills out there, they're trading at a negative yield. Well, what does that lead to? That leads to the repo market, which I won't get into the repo market because that in and of itself, that's a whole college course. That's a graduate level course on the repo market. I'm not going to get into that. I'm not qualified although I do generally understand what the repo market is. I could explain it briefly, but I'm not going to do that here. I talked about that in the past. If you want to search my channel, actually, does YouTube even still allow that? I don't know if you can search just my channel. But I had a lot of videos back a couple of years ago talking about the repocalypse, which was when the repo market just about seized up and completely broke, which would have, that would have been a financial apocalypse, hence the name repocalypse. Basically, repo, it's short-term lending, and it will go negative if you have all of these government, if you have all of these short-term Treasury bills trading negative, the repo market's going to go negative. And so you say, well, duh, we're talking about short-term interest rates, so that short-term interest rate is going to go negative too. Well, what's that going to lead to? And what George asserts is that because 2/3 of the repo market, 2/3 of the lenders in the repo market are money market funds, which money market funds are investors looking for a positive yield. That's why you have a money market fund. It's almost, it's the next safest thing after a savings account. That's the idea. It's supposed to be something that yields you more than a savings account. And this makes up 2/3 of the repo market. So what George is saying is that if the repo market goes negative, you have all these people in money market accounts who are going to pull their dollars out because they're saying, why would I want to be in a money market account if I'm losing money? I'm just going to go take my money and stuff it under my mattress or put it in the bank. Sure, I won't earn anything, but it's better than losing money. That's how they're going to look at it, which, seems appropriate to me. So what he's saying is that if repo rates go negative, then there's going to be liquidity is going to flee the repo market. And so he says, therefore, repo rates will spike, just like they did a couple of years ago, and then that's going to push up mortgage rates, because if repo rates spike, that's going to push up mortgage rates. It's just, I won't get into the mechanics of it, but that's just, it's a general fact. And this is the part where George loses me, because, okay, let's agree. I agree with everything that George has said so far. But who says that, okay, people are going to flee the repo market if rates go negative? And so the repo rate's going to spike and just stay there. Why would it just stay there? If the repo rate spikes because everybody's fleeing because the rate went negative, well, then everyone's going to put their money back in that money market account because they're going to go, ooh, I can earn all this interest. I can earn 5% in a money market account. And that's going to lead to a huge surge back into the repo market. And it will find its equilibrium, probably somewhere above zero. And so I don't understand. Now, George might have an answer to this because he's a smart guy, and this seems like a basic question to me. Why would the market all of a sudden stop functioning? Because that's what that would mean. If you're saying that, okay, the rate is going to plummet negative, and then everyone's going to flee the market, and the rate is going to skyrocket, and then just stay there. Prices do not remain the same in a publicly traded market. Prices fluctuate very quickly. So what is it that would be holding the repo market up there? If the problem that George is proposing here is that the repo market cannot function with negative interest rates, well, then the answer is, then the repo market is going to have a positive rate of interest. So that's where I'm at with this. I think this is a very intriguing topic. I would like to see it explored more. I think that it's extremely relevant based on what's going on at the moment, because I think that any of these things that I discussed are very real possibilities. And hopefully that means that I will get an answer soon enough to my question. That, if the Fed does all these things, why would it necessarily work out that way? Or why wouldn't it? Maybe I'm right. Maybe, what I'm saying is correct. And George is wrong. I don't know. But, I don't often ask for comments. Because, normally, what more could you add to what I have to say, right? But if anybody has any idea and can elaborate on what I explained and on George's point, even if you didn't see his video, if you just have an idea as to how this would work, why all of a sudden the repo market would seize up permanently, to why this spike in the repo rate wouldn't just lead to a massive inflow. So with that said, I will bid you all good night.